we got to get ready for a lot of things because there's an awful lot of debt that they're looking to pay back, and they want us to foot the bill.
So they do want us. That's exactly right. They do want us to foot the bill, and I'm going to hopefully show you some ways maybe to circumvent that. I like the free analogy. That's great. And if you think about it, if we can show you in the next, maybe 90 minutes that you're with us, even how to save $500 a year. Imagine after 10 years, what you can do with that $500 back in your pocket year over year over year. And that's at a minimum, and that's not even trying. Okay, but our objective will be to kind of save you money and show you some, I don't want to say tricks, but show you ways to implement the tax code to your benefit, right? Now, before I start, I'm going to bring up a slideshow for everyone, but I want to just go over a couple tax-related items. I jot them down. I carry this little notebook around with me. And when something pops in my mind, I write it down. And I wanted to go over just a few quick things that I think you should know when it comes to your taxes for 2020, okay? The due date, April 15th, which usually means I'm on vacation right now, but since the IRS was so kind to extend that date, our taxes are actually due May 17th. So you still have time to file. You still have time to file an extension. If you were wondering when I do my taxes, I do my taxes October 15th, in case you wanted to know. So never feel like you can't file an extension or somehow that's bad. The most important thing when it comes to your tax return is an accurate tax return, not when it's filed, during that given year of when you're allowed to file it. Secondly, if you are self-employed, which I imagine many of you are, and you had income during 2019 or 2020, the Paycheck Protection Program, the PPP loans are still available through the end of May. I would highly, highly suggest you get out there and try to lock yourself into one while they're still available. You have to the end of May to apply. And I've helped numerous people get them. They're a great thing, especially for self-employed people when they maybe need a little bit of extra cash during this time. And also last year, if any of you, I'm hoping this doesn't apply to anyone, but chances are that it does. If you actually had COVID or had someone in your family that had COVID or were impacted because of school shutting down, you have little kids and they all had to come home last year, and you're self-employed, there are two credits that you need to look at: the family leave tax credit and the sick leave tax credit. Those are tax credits that actually pay your tax for you, and those could be worth upwards of $15,000 worth of tax payments on your behalf that the government will give you if you had difficulties with COVID. So I would suggest if you did, sit down with your tax preparer or whoever they are, go through that and get the money that you're deserved and the money that's out there for you if it impacted your life severely last year. Okay, so that's my little ramble for taxes for 2020. Now let's get into some of what I want to help you with today. I'm going to screen share here my screen. There we go. All right, so hopefully you can all see that. You see business tax strategies right there. Okay, so let me give you a quick me in three, just so you know who's talking to you. I think that's only fair because, to be honest, I have a great sense of who you are because I deal with entrepreneurs and small business people every single day. So I graduated with my master's degree in accounting so long ago. If you can see the gray hairs on the side of my head, I went to work for Ernst & Young. You may know who they are. They're a kind of a global financial accounting firm. I was there for about 10 years. And decided that I enjoyed working with individuals and small businesses much more than kind of these multinational corporations. So I left back in 2003, went into private practice, and have been helping small businesses ever since. So hopefully today I can help you. So let's go through some of this stuff. And I like to start right here. Why? Because it's the most boring slide in the world, right? It is. You're just looking at tax rates, and probably half of you are like, well, I didn't know that was the exact breakdown of the tax rates. The other half are, do I really care about tax rates? But what I want to do for maybe the first couple minutes is simply just change your mindset on what you're looking at, because this has a big factor in how it impacts what you purchase and what you have to pay or split or share with that wonderful partner we all love it or known as the IRS. So you may kind of figure out and look on this particular table, but I want to go through kind of how this impacts you. Now, sometimes I bring some things that I personally like. I'm a car guy, I love cars. So of course I'm going to put a nice Ferrari F8 on this picture for you. And let's say that I was, I had just connections. I'm connected somehow with certain people in the automotive industry, and I was able to acquire this particular car for $200,000. Now, I know that the worth of this car is far greater than that. So I say, you know what? I'm going to flip this thing. I'm going to make a quick $100,000. I'm going to sell it and just dump it for $300,000. And I'm going to put $100,000 back into my pocket. Of course, that's after I put about 1,000 miles on it, right? So let's say I do that 100,000 comes in. So my question to you would be, did I really make $100,000? Is that really what I get to put into my pocket? So when I am looking at financing, my cash management system, cash flow ins and outs, do I get to take that $100,000 and just stick it in my pocket? Or is there someone I have to split my profit with, known as the IRS, with everything that I make? Okay, and that effective tax rate that we were kind of looking at, those tax rates, that effective tax rate goes into this calculation. So for this example, let's say I was at 20%. So I make that $100,000 really in my mind. When I'm thinking about that 100,000 that came in, I have to think, okay, there's 20,000 that really needs to go to the IRS, or possibly could I put some tax planning into play to reduce that 20,000? But after all the income that comes in, you have to realize that a portion is going to go to your partner, the IRS, and it is your partner. It's your partner in everything that you do. If you don't believe me, take a look at your paycheck. If you're employed, if you get a W-2, you'll see Social Security taxes, Medicare, right? Your IRS withholdings, your state withholdings, if you have one, right? They are impacted into your life in every which way that you can imagine. So when we look at what we make, we have to understand that there's a portion that has to go to the IRS. Now on the flip side, and there is a flip side, and that is when I'm buying something. So when I make money, they take some. But when I'm buying something, what really happens? So I love electronics. I'm kind of a tech geek, and I will buy them even if I don't use them, just because I think they're awesome. In fact, I was just talking to Chris about that wonderful board that sits behind him, wanting to know all the details about that. So recently I went and bought a new iPad Pro, and the iPad Pro was $1,649. Now, the problem with Apple, if you're an Apple user, I guess, is that Apple never puts their stuff on sale. Unless it's old, right? But anything that's new never goes on sale. It's a business. It's a brilliant business model. That just means that no matter where I am, no matter what state I'm in, if I go to an Apple store, it's going to be the same price. But I don't necessarily want to pay that price. $1,649, it's quite a chunk of change for a tablet. Then I add on Apple Care, total cost of $1,700. Now, because I'm going to write this off, because I'm going to use it for my business, guess what happens with the person I split money with? Whenever I go to buy something for my business, it becomes on sale. It goes on sale. So take that same effective tax rate of 20%. What really happens with the cost of this iPad is I get to save $356. So why Apple doesn't put it on sale, my wonderful partner chips in and puts it on sale for me. So what is the value of a purchasing dollar, or what is the purchasing power of every dollar when it comes to business and being able to deduct that? I mean, that's the beauty of it. So if I'm buying something for my business, your mindset should be, well, everything's on sale. Because I'm going to write it off, I'm going to save tax dollars on it. So that's what I like to kind of start off with when I'm talking to people. Understand that when I'm making money, sometimes I got to split a little bit with my partner. But when I'm paying money or buying something for my business, all that goes on sale as well. So a few years ago, if you remember, when the let's call it the new tax laws, the Tax Cut and Jobs Act came into play, it was really interesting. It was interesting in that it kind of happened at the very tail end of the year, and then we went through a year, and we were really wondering, especially me on the CPA side, right? Especially me on how am I going to implement a lot of these kind of new rules, tax changes, and really help people tax plan around what was happening. And I have a little example here. If you know that state and local taxes are now capped at $10,000 within your Schedule A or on your tax return. So that really impacts my coastal states mostly, because coastal states tend to have higher property taxes like New Jersey or California, for example. They also have higher state taxes, like California, not to pick on them, and New York, for example. So really, you could be losing a lot of tax deductions because of this $10,000 cap. Now, when it passed, it was what, 17? I was in California, Orange County for the holidays. And I had a client call me while I was down there. He's a real estate guy, lives back in Ohio. And he said, Joel, listen, I see what's going on with this new $10,000 cap. And what I want to do is I'm going to prepay all my property tax, right? I'm going to prepay it so I can just front load all these deductions in my Schedule A for 2017 before everything changes in 2018, because I think based on what I'm looking at, this stuff is just going to get capped out and I'm going to lose a bunch of money. Now, we started discussing this. I'm going to say we discussed it. If you were to ask him, well, to be honest, he may say we argued over it. But in the end, I convinced him not to do it. And then lo and behold, about 2 weeks later, because it was in the news and it was all over the place and I was reading about it practically every day, the IRS came out with a little memo. Now, the IRS loves to use words and words that they can kind of grab that will impact how we as tax preparers or how you have to follow certain tax codes or tax sections. And the word that they came out with this in this particular case was assessed. And what they said was, unless the property tax has been assessed, you cannot deduct it on your tax return. So when does the assessment happen? Now, typically, the assessment happens during the year in which I pay the tax. So for example, I live in Utah. Property taxes are assessed roughly at the end of summer, and we pay them in November. Now, I know California is a split year, for example, but that's when they're assessed. So had he paid those property taxes in 2017, he couldn't deduct them in 2017. 2018 rolls around, and because we're all cash-based individual taxpayers, he couldn't deduct it in 2018 either because he had paid it in 2017. Now, that's what I call dead money, and I hate dead tax money. Okay, but that's kind of the way the IRS does, or how they view changes. They throw in words. They like to try to skew things maybe to their particular advantage. And what happens is then we as individuals, we as business owners and myself tax preparers, we have to look at what they're interpreting and then look at ways that we can then implement code sections around them to try to have the best impact or result from a tax return perspective that we personally can have. And one of these changes that came out, and I don't know if you're aware of the QBID, as I call it, the qualified business income deduction, is this wonderful little thing that allows us to pay less tax on the money that we earn from our business. Now, the beauty part of this is that it's free. It doesn't cost you anything. The only requirement is, hey, go make some money. So if I make some money and I'm self-employed, well, I might just get a little 20% knock when it comes to my personal tax return. So let me give you an example. Let's say that let's say for my services, right? I'm a CPA. I do tax planning, tax consultations, a lot of financial reviews. Let's say I brought in $150,000 for all the services that I performed for the year. In order for me to perform those services, it cost me $50,000, right? Left me with taxable income of $100,000. Now, what the QBID allows me to do is take 20 grand or 20% off the top, and I only pay tax on $80,000. It's a great thing. It's a great tax incentive. And really, the reason I think that it happened is when they lowered the C Corps, the corporation tax rates. This was kind of the offset for all of us pass-through or small business owners. This, lower corporate, don't pay as much tax. And this is kind of what they gave us for self-employed people. But it's a beautiful thing. Now, here was the issue. And I always suggest people do this. It's a 10-minute exercise. And if it was missed, it actually could put a lot of dollars back into your pocket. So when this thing first came out, even I was unsure about how to do a tax return with the QBID involved. And the funny thing about this is that, let's say I have a LLC and I do a 1065, which is a partnership tax return for that LLC. The QBID has to be accounted for within the LLC, but the actual deduction takes place in my personal tax return. So somehow these two tax returns need to connect. And what I saw in 2018 is lots of times, even CPAs were unable to make that connection correctly, and it simply was left off the personal tax return. So if you are self-employed and you had income in 2018 and 19, I would go back and look at your tax returns. In 18, it's going to be on page 2. On 19, it's going to be at the bottom of page 1. It is its own line item. And if you have income and that line item is blank, it's an easy thing to go amend for. Easy, easy. Flow it through, get the money back that you are owed. So it's always a good 10-minute exercise to do it, but just look at that QBID 20% reduction in your self-employed income. Now it has to be active income for the most part, but self-employed income that you can have within your tax return.
Joel, let me ask you something about.
Go ahead.
Let's say somebody, individually gets a 1099 for business that they do.
Okay.
Could they take the income from that 1099, then write a check from their personal account into their LLC account, where that money is then used for marketing and other things, and take advantage of this? I mean, would that be something that would be allowed?
So the specific scenario that you're describing is something different. So when it comes to my company, I have different ways that an LLC or any business actually brings money in. And one way is for services, like if I perform services or if I sell product, that's revenue. And that money comes in and then I deduct my expenses, gives me income. Now, me as an owner, if I interact with my business, if I either push money in or take money out, that's part of what we call our investment or equity stage. So it doesn't impact my revenue and expenses. It's just my investment into the company. And when the company makes money, it's the company paying part of that investment back to me, but it doesn't impact that. So in that particular scenario, it wouldn't work. Now, from a 1099 standpoint, let me turn that on its head a little bit. And let's say that 1099 is active income, which typically it would be, right? So if I have expenses against that and have income, then I could take advantage of that 20%. Or if I got a 1099 personally and I have an LLC that I just own, I can always push that money into the LLC, include it with the other revenue that I have, and then try to take advantage of it that way. So there are different things you could do with that 1099 to move income around to create the scenario that you're talking about. But if I simply just give money to the company, then it doesn't work.
Okay, but if it's related to the LLC's activities, except for you're getting paid personally because of maybe licensing situations, that might be, because you had mentioned that might be a way you can.
That's exactly right. And actually it happens all the time.
Yeah, it does.
So I do tax returns for people where they have businesses on the side, but for whatever reason, someone decides to 1099 them individually. So what I do is, so I account for it within their tax return, because if you don't, the IRS will send you those nasty little letters, right? So I account for it there, and I just deduct it and say, hey, income recorded in this LLC, here's the EIN. Then I just take it over to the LLC, include it in income, and push it over to that. Awesome. Yeah, so you can do things like that. So like I said, so you kind of want to just, instead of looking at it this way, just slightly change it to make it work. Okay, so let's go. Let's talk a little bit about cars. Why? Because I love cars, and and I want to drive. Off, as you can see from my earlier example, the most expensive car that I think I can get away with, or that my wife will say yes to. But I want to take advantage also from a mindset standpoint, in that if I'm using it for my business, guess who's helped paying for that car? That would be Uncle Sam. And we do that in the way that we deduct the use of that car. I like to say that, if I'm an accountant, so if I made $1,000 a month, 800 of it, and I'm not kidding, would go towards a car, and I'd figure out how to live off of $200, because I'm an accountant. That's what I do. Anyway, there are two basic methods of writing off an automobile. We have a mileage method and we have an actual method, and they are very different. And I know that everyone says, yeah, I know I can write off my car. But really, you have to look at these two scenarios and figure out which one is actually best for you, because the mileage method doesn't work for all scenarios, and the actual method doesn't work for all scenarios either. So let's just be aware of what they are. So the mileage method is easy. The IRS every year puts out a cents per mile that you can deduct based on the business use of a car. Now, the interesting thing when it comes to this 56 cents, for example, for 2021, is that it's an average, right? It's just an average cost. So what they try to do is say, okay, how much did this car cost? What are the repairs and maintenance costs of that car every year? How much gas do you have to put in that car? What's your insurance? All those types of things. And then they blend it all together and come out with an average rate. Now, the issue is cars can cost $10,000 or $100,000, right? So that 56 cents may not make a lot of sense depending on the type of car that you drive or how much or your miles per gallon that you can get out of it. Okay, but this is the easiest method to use. If you're putting lots and lots of miles on your car, if you're driving all over the place, oftentimes this will give you a kind of a better result in your tax return. But it's easy. If I drove 10,000 miles per year, 5,000 miles of it were for business, 5,000 times 56 cents, boom, there's my tax deduction. Now, the actual method works a little differently. So the actual method takes into account the actual cost of the automobile that you are using. For example, I'm going to look at gas, repairs, insurance, maintenance, your carbon fiber tidbits that you put in there, you know, those smelly little pine tree things that you hang from your rearview mirror. All those things are going to go into this pool. And then I'm going to look at how I use the car. So again, the 10,000 miles, 5,000 miles for business. Therefore, I'm at that 50% ratio. I'm going to push that against all of the expenses within my car, and that becomes my deduction. So they really do work differently. That's why I say you have to kind of sit down and figure out what's going to be best for you. I will say that out of all the tax returns I do, all tax returns I review, I would say probably more than 70 or 80% use the mileage method. Oftentimes there has to be a case for the actual method. You have lots of people in construction, for example, where they need to buy trucks. Oh, I love trucks. Trucks from a CPA standpoint are like candy. The things that I can do with large trucks and heavy SUVs from a depreciation standpoint are beautiful. I can put them in play. I can toy with them. I can do all kinds of things to manipulate that and kind of get to expenses that we want.
Well, asking for a friend, like how heavy is the vehicle got to be to take the deductions to the maximum?
So 6,000 pounds.
Okay.
Yeah, 6,000 pounds. And SUVs and trucks don't work the same way. So trucks, you know, have you seen the price of trucks lately? I mean, Dodge just came out with that TRX, the $100,000 truck that has about 750 horsepower. I mean, I love it. It's totally useless, but I would drive it every day if I could. So that puts over 6,000 pounds because it's a truck. I can write off the whole truck if I'm using it for my business in one single year, right? SUVs work a little differently. I'm maxed out at about $25,000 for that first year, plus some depreciation. So you're kind of in the 30s, depending on the cost. But yeah, kind of baseline at that 6,000 pound mark is what you use. So really, like I said, sit down with your tax person, see what you think may work best for you from a kind of an auto deduction standpoint, and then interact that method into your particular tax return. Now, let me tell you one little thing that everyone forgets. If I'm using the mileage method and I have a loan on my car, I can still write off my interest. And people will leave that off their tax return every single time. I have to ask for it every single year from every single person. That's how I know. And so just remember, go back and look at your loan on your vehicle. If you haven't, hey, you're going to throw in another $1,000 maybe, or whatever the case may be, and you're going to throw some money back into your pocket. So don't forget those little things like that.
Hey, Joel, Colleen had a really good question here that's very relevant for the vehicle. She said, I purchased a particular vehicle on width and rear cargo area, so it holds my paintings and canvases. It's also my personal vehicle. Is it possible to split the mileage based on different activities, business versus personal, and are the payments deductible, or does she need an LLC for the business to run that through?
Okay, so payment. So I'm gonna let's say that it's not leased. Okay, so we don't use the actual physical payments as the deduction. What would happen in your particular scenario is that the deduction of the vehicle would follow its usage. So that means if I own a car individually in my own name, which oftentimes is cheaper than a business, because when you go buy a car under a business name and you have to get a loan on it, usually interest rates are higher. You go talk to your insurance guy, insurance rates are higher, so you pay a little bit more under that scenario. But let's say I bought it individually, the deduction of the car will follow its use. So even though I use it personally, for those miles or that percentage of activity that I drive that's business use, I get to deduct it. So yes, you can. So we don't follow payments. We look at depreciation and actual costs, or we use the mileage method. If it's a lease, then we do look at payments. So, but from a purchase standpoint, that's how it would go. So yes, you can.
And then some of the dealerships, when you're buying a car, I remember when I was there, they try to upsell you to all those maintenance programs, the tire package, the rim package, the air freshener package, you get it.
You lose your keys, the $350.
There you go, right? They got an insurance for that. Can you write off all those packages? Because I know that they tell you can, but who knows if that's real.
Yeah. So all of those packages would go into the cost of the vehicle. So yes. So let's say my truck cost me 60 grand. I have all these warranties and different packages that I purchased that push the value up to $70,000. And that's what I was actually paying for the car. $70,000 would be my basis, and $70,000 what would go into my tax return. So you do include it.
Perfect.
Sales tax, everything, right? Everything. Now, I know that everyone probably is familiar with this particular picture. And I just wanted to go over one aspect of it, because I know, Chris, you and I kind of talked about it a little bit, and that is with the interest and what happens with the interest under this scenario.
And
so,
just to reference this, everybody, and some of you have seen this, some of you will see this, in our trainings that we do. This is where we're using the privatized banking policy to buy the vehicle. Then we're leasing the vehicle to the company to get the tax write-offs, just so everybody knows what this is.
Yeah, so there's two interest components to this. One would be the interest that I'm paying back to my bank, so to speak, right? That I'm paying back for the money that I borrowed, right? So, and the second interest component would be the interest I am earning as I receive lease payments from my company that is leasing, or that I'm leasing the car to. And I just want to make people aware that what's going to end up happening is you do account for both sides of this. The interest that I'm paying back to myself, being the bank, I am going to deduct that because the function or the use of that particular amount that I took out was to purchase a car that someone is then leasing from me that makes a business transaction. And then on the flip side, the interest that I am being paid as part of the lease arrangement, I'm earning interest income off of that lease deal. So what will end up happening is you'll have kind of a lease expense, a lease income, and depending on how you do it up, those could kind of offset, but essentially you're just kind of pushing and paying yourself money back instead of using a bank. So I just want to make people aware that there's two sides of it and just account for both.
Love it.
Okay, let's talk about Code Section 162. I know when I bring up code sections, people probably aren't, they're like, sleeping material. But Code Section 2 is really, really important. And the reason it's important is because basically it's how we deduct anything within our tax return. And it's, again, remember when I talked about verbiage and what the IRS likes to do with words? This is another case of what they like to do with words. They put in their ordinary and necessary. Now, I've been doing this, for going on decades, and I have still yet to hear a great kind of explanation for what is ordinary and necessary. What is ordinary and necessary? Is it the same for you as it is for me? Would someone who lives in New York, doesn't have a car, takes the subway everywhere to do his business, would they have the same types of expenses as I would have living in a very rural area, taking a car everywhere that I need to go? So really what ordinary and necessary comes down to is how you choose to operate your particular business based on where you are located and based on kind of what you do, products, services, whatever that case may be. And let me give you an example on this. So my neighbors are amazing. However, if they know I'm a CPA, they know I deal with the IRS all the time. And so unavoidably, at some point, I know if anyone gets anything related to the IRS, I'm going to get a knock on the door. They're going to come in and they will give me some pleasantries for about the first 3 minutes and then just dive straight into, Joel, I got this IRS letter. What do I do? So I had a neighbor who he owns this, he owns a company that does landscaping. And he does huge landscaping jobs for kind of multi-million-dollar homes and kind of shopping centers, that type of thing. And he said he's getting audited by the IRS, and he's meeting with the IRS agent. Now, granted, he's in landscaping, okay? So he owns lots and lots of equipment, backhoes, trailers, trucks. I mean, anything that you can think of that you would need to do any type of landscaping. But the IRS agent told him that it was not ordinary or necessary for a landscaping company to have multiple backhoes, right? So that is what I talk about, ordinary and necessary. What is ordinary and necessary? From the IRS's terms, oh, you only need one backhoe to do everything you do. But in reality, for him to conduct his business, he needs all three. Now, I will say that all three got passed, and it was all good in the end. But that's kind of the attitude that they have, and kind of the fight from our end when it comes to ordinary and necessary. So this is how I would explain it to you. When you're looking at your finances of the business and how you spend your money, really take a look at how you're spending your money. I can't emphasize that enough. Go through all of your bank statements, go through your credit cards, go through, I mean, we pay a lot on apps now. Lots of people use Venmo, even for business transactions. Now, I will say that Venmo wasn't set up for business transactions. Sometimes it's kind of hard to track that kind of stuff. So maybe you look at other means of collecting money, but if that's the only thing you have and that's the only thing that's available to you, you got to get paid one way or another. But we do use a lot of apps, and so go look at those. We don't use as much cash, obviously, anymore. So cash becomes kind of less of an issue. But I would go through and I would examine it. How am I spending my money? What can I actually allocate over to my business, say from my personal bank account or a credit card that's not maybe 100% business use, which I'm going to stress I would prefer you to have a 100% business use credit card. But I would really be looking at how I spend my money and what it took for me to earn $1. And that is probably what is going to be ordinary and necessary for you. So really look at what circled around that dollar. And that's probably ordinary and necessary for you. Now, I also like to talk about business optimization because I think it's important. So I think my entity and the type of entity I choose to house my business really kind of sets the stage for how I'm going to operate. That's not to say that those who are just sole proprietors, it's a bad thing or a negative, but I'm just going to say that I prefer people to be in entities. If I'm going to be in business, I want to kind of act like I'm in business, show the IRS that I am in business, and do those typical things that you would expect a business to do. So if I'm creating my entity, whatever that may be, then I want to look at my business operations and how I'm maximizing my revenue, my cash flow. And remember that financial accounting and tax accounting are not the same thing. So while I'm trying to make as much money from a finance side to put money back in my pocket, tax comes in. And then what we try to do is reduce that income as much as possible. And then I also look at my retirement plans and what do I have set up to put money away in the future, because retirement plans can be very, very interesting. And I'm going to tell you why right here. Now, if you were to ask me, hey, Joel, I want kind of the quick and dirty, give me fast 3 ways that I can save on my taxes. This is what I'm going to tell you: defer it, spend it, or connect it. Defer it, spend it, or connect it. 3 quick ways of how you can save money from a tax perspective. What do I mean by defer it? I'm talking about those retirement plans. Retirement plans, when I have income and I'm self-employed, become a deduction for the business, which means if I have $100,000, I'm putting away, for example, $25,000 into a specific retirement plan, now I'm only paying tax on $75,000. It's a way not only to reduce the taxes that I'm paying now, but also put money away for my future. Then, depending on the vehicle, can I borrow money back out of that particular retirement plan to put back into use into my business, which I know that Chris probably talks about quite a bit. So just utilize retirement plans to your benefit from a business perspective. The second one is spending it. Yeah, spending it. So we talked about that Apple iPad that I went and bought earlier, right? When I went and spent money, what did it do? It reduced my income. Therefore, I pay less in tax, and I got the wonderful IRS to kick in part of that spending for me. This is why you see in the fourth quarter these massive spending sprees, because what people will do is they'll look at, okay, what happened to me throughout the year? How much income do I think I actually have, right? As I'm going towards the year. Okay, now what do I need, right? So if I get towards the end of the year, do I need a new computer? Do I need a new phone? Do I need a new computer monitors or technology within my house? Can I go buy and prepay for advertising, for example, for my company? That will benefit me in 2022, but I get the deduction right now because I had a great tax year, right? Or a great finance year or income year. So really I'm balancing out that spending. But when I spend money, I reduce my taxes. And finally, I'm going to say connecting it. Let me explain connecting it this way. So here in where I live, okay, it's kind of south of Salt Lake City. We have this area now that has kind of developed up just west of where my office sits, and they call it Silicon Slopes, right? And that's because all these technology companies have come in and kind of gathered around in a specific area, and someone coined it that, and I actually kind of like the name. But anyways, down there is Adobe, and Adobe has this amazing, beautiful glass building that sits upon this hill, overlooks the lake and the entire valley. I mean, it's beautiful. I've been in there a couple times. Has a gym, has a cafeteria, everything that you could want inside there. So let's say I'm employed there. I love my job. I love my job. I love what I do. I love my coworkers. I love my benefits. You know, they give me great pay. So I get a W-2, you know, very happy. What are some of the things I'm going to have anyway? Yeah, I'm going to have a car to get me to work. Yeah, I'm going to have a phone because I got to communicate. I'm going to have internet. It's almost a requirement at home nowadays, as long as with computers and technology at my house. Got to eat, do some traveling, right? Doing some of those things. So you're going to have things that could be business related regardless of whether or not you're in business. So connecting it simply means taking a look at what I'm paying for personally, and to the effect I can use it inside my business. Now I get a deduction for it. So the car that maybe the Adobe employee has, because now I'm using it for my business, much like the person who had the canvas and prints in the back of her car. Now I get to deduct part of that. I'm using the internet at home for my business. Ooh, now I get to deduct that. My phone and so forth and so forth. So I would be looking at what I'm paying for personally, looking how I'm using it in my business, connecting those two, again, driving down the taxes that I may owe. Okay, I know, Chris, you and I talked a little bit about this, and what I call team stacking. I'm gonna give a kind of a little story or background to myself. That's not super flattering, but I think it's worth mentioning. So when I left Ernst & Young, you know, I was a over-enthusiastic individual who had been dealing with companies that made lots of money and probably thought he knew everything that it came to business. And, you know, I was, you know, going to crush it. So I come out, I start setting things up, and I say to myself, you know what? I could go buy a computer from Dell, or I could build it myself, and I will save $200 on that computer, which means every computer that I build within the office, I'm going to save $200 on. Oh, I'm an accountant, right? So math is like going through my head. I'm building these spreadsheets up there, and I'm saying $200, $200, savings. That led me to say, you know what? I'm going to build my own server. I'm going to put my own phone network together. Now I'm going to try to build my own website, which, let's be honest, was a horrific failure. But I was doing all these things, right? So let's say tax season is upon us, just like it is right now. And all of a sudden someone walks into my door and says, Joel, computer's not working. What's going on? Can you come take a look at it? So then I get up, I go take a look at it. I'm there for like 3 hours trying to figure out this computer. Finally, I get it to work again. And then I come back in 2 hours later, someone else comes in and says, hey, this isn't working. My phone is doing this, that, and the other. Get up, go over there, another 2 hours working on a phone. Now, during a week, I'm wasting 20 hours dealing with all this administrative stuff. And what am I not doing when I'm dealing with all that administrative stuff is what it is that makes me money. I'm not doing any compliance work. That's tax returns, right? No compliance work, no tax planning. I'm not dealing with my clients. I'm not dealing with those people that pay me. So what I ended up figuring out early on that actually cost me a bit of money is that I like to team stack now. I like to put people in place who are experts in their area. Am I ever going to be an expert in computers? Absolutely not. I don't deal with them enough. Or a phone system or a website, right? I don't deal with that stuff. Or my legal issues, right? I don't deal with that stuff every day. What I do deal with, tax returns, tax planning, tax compliance, financials and accounting, right? That's what I'm an expert at. That's where I should be spending all my time. And so when I did that, I saw a massive change in how kind of the firm worked, how I was able to kind of grow things more exponentially. when I realized that really putting people in place around me that allows me to focus in on what it is that makes me money becomes a real big part of just simply being a business owner. So that's my unfortunate tale of when I started the firm.
But that's such an important thing. And, just so everybody can put that into perspective, I mean, there's always a cheaper way to do things, but that cheaper way often will take time. So then all of a sudden you need to decide is, trading hours, for dollars worth it. And I know back in my early years as a business owner, I always tried doing everything myself. Bookkeeping. I'm like, all right, well, I'm going to take a class on QuickBooks. I'm going to learn how to do bookkeeping, which was a great class. It was good to have this knowledge. But then what I found, this is when I had my skateboard, snowboard shops, there's tons of transactions. Orders came in every day. I'm spending an hour just entering invoices into the computer every day. And then I'm spending another 2 hours on weekends, because it's the only time I could find, paying the bills so that they were paid on time for the net terms. And I'm doing all this, and I'm doing it because I don't want to pay a bookkeeper to do this, because I'm the cheap one. But really what I'm doing, and I didn't realize this, I did this for years. And I would literally give up weekends paying bills. Now, I don't know if any of you run a business, but where you just can't find time during the week. So, Sunday, you devoted a couple hours Sunday to go pay bills. Tell me how miserable you are, or if you're as miserable as I was, when you go into the office on a Sunday when it's beautiful and sunny outside, not 6 inches of snow like we have here in Buffalo, and you're paying bills because you just can't give it up because you're trying to save yourself a nickel. When what would be more valuable is hire the bookkeeper. They'll do a better job because they're only focused on that. You're focused on 100 things. Not only that, you then get your weekends back, or on weekends, you go out and you do something you enjoy that actually makes you money instead of something like that is really costing you money. Because by you doing a task like that, by me doing that, I was literally saying to myself back then that I was worth, I don't know, what was it? Maybe let's just say a bookkeeper would have cost $15 an hour. I was basically labeling myself as somebody that's only worth $15 an hour because I'm doing a task that I could hire out for $15 an hour when I could have been out doing something that made me $100 an hour. But because my mindset was messed up and I knew that I could do it cheaper, then, or technically you look at it as free because you're doing it all. It doesn't cost me anything. It costs you your time. And when you view things that way, your time is worth exactly what you could hire somebody to do. So think about that. Like today, maybe this is the extreme, but I intentionally don't mow my lawn because I know I can pay somebody $30 to take 2 hours and mow my lawn and do all the stuff. It's not because I don't love sitting on a lawnmower, getting a tan, drinking a beer and mowing the lawn. It's because I can make a lot more doing something or doing nothing, and that's still a better use of my time. So we just sometimes have to decide what we want to spend our hours doing and what's more valuable, doing the task because you think it doesn't cost you anything, or actually going out and doing something that would make you double, triple, or quadruple that amount because you actually have that time back.
Yeah, I love that. That's a great example. Thanks. I love hearing that because I just like the idea of, create a business, not a job for yourself. So let me go through, there we go. Okay, I don't want anyone to make this mistake. And having dealt with tax people for years and years, I think this is important for any entrepreneur, business owner to understand. Okay, when it comes to your finances, having your finances in order and understanding how your cash comes in and where your cash is going and where your net income is in order to make proper business decisions is probably one of the most or the best way for you to actually save money when it comes to your tax return. Okay, you need to have an understanding of your financials more than me. My job is to be able to implement, right? Tax code, tax strategies, Section 162, 179, 192, all of the kind of de minimis rules and all the things that I do on my end based on the financials or the information that you give me. And for us or for you to have any productive conversation with a tax professional, they need to understand or look and talk to you about your numbers. So if you were to come into my office and say, hey, let's talk and let's do some tax planning. I say, awesome, get in here. Let's do some tax planning. I say, okay, so where are you at this year for revenue and expenses? And you say, I have no idea. Well, how effective can I be from a tax planning standpoint? I can't be, right? I mean, it's impossible. No one No one needs to understand your numbers better than you do. So what are some of the things that you should be doing? You should be reviewing your bank statements every month, right? Being proactive with creating those financials every month. So if I know how much money I have, then I can make those proper financial decisions on how I can spend that money to my benefit, right? So those are just some of the, if you can kind of look at those are some of the ideas that I think people should have. You need to know your money you need to know your money better, or your financials better than I do. My job is to come in and kind of apply tax code to a particular situation. So I don't want you to make that mistake. Okay, I want you to be productive when speaking with tax professionals, because that's where you'll get the best bang for your buck. And I'm going to give you another example. Okay, between the chef. So I like to cook. Sundays for me are kind of a big deal. I spend a lot of time planning out a meal that I'm going to cook for the family on Sunday. And I spend the rest of my time during the week looking at pots, pans, and knives. So I'll plan these meals out and go. So when I came to this example, I thought about a chef, and oftentimes my daughter will say, "Hey, Dad, you should go open up a restaurant." I say, "It's a great idea, but I'm kind of too busy with what I'm doing." And the idea of this is a chef. Okay, when it comes to a restaurant, we'll think of a couple of things. A chef will think of, okay, I got to create a menu. Ooh, I want to like push the boundaries of what I can create from a meal perspective. What's my environment going to be when someone kind of sits down, the experience they're going to have from a restaurant standpoint. So, I mean, I'm so bad with this stuff. Like part of my vacations revolve around a restaurant that I may particularly want to go to. So you're looking at specials, you're looking at your reputation within the kind of community of the type of food that you make. That's the chef. If that's all you want to do, awesome. Then you should just be a chef and be a chef for someone else and just be employed somewhere else. The business owner looks at things completely differently. While they take all that chef aspect into account, they also have to look at rent, cost of food, overhead, income, maximizing profits, expansion, all these other things from a mindset standpoint, right? So we talked about understanding our financials a little bit better. So when it comes to practical application, like Chris was just going through, remember that as a business owner, you're creating a business. You're not just creating a job for yourself. You're actually creating a business itself. All right, let's talk about the IRS now, a little bit about the environment. It has changed over the years. And probably one of the biggest changes is that the IRS just has to collect money. And they have to get smarter about how they collect money. So their budget actually does not go up a lot. They were stuck at about $11.3 billion for years. This year, finally get a little bit of raise, they're up to about 12 billion, not a lot. About 50% of that is used for enforcement. You can see I have a little stats of kind of on how much money they're currently collecting. But what happened is they had to get smarter about how they collect money. Okay, and what they found out is that audit letters, now I know I can look and see how many participants are here. I know there is a nice little chunk of you that have received these audit letters or an IRS letter in the mail, because they've realized that, hey, I can sit down with you face to face and go through your tax return, or I can simply use a 50-cent stamp and a computer to generate a letter for me, and I'm going to end up collecting roughly the same amount of money. So actually, south of where I am, they used to have an IRS audit or an IRS building there. It's gone now. It doesn't house any employees. It's just kind of a shell. And what happens is if someone on the off chance were to have a face-to-face audit within our particular area, they'd fly someone in from San Francisco, do a little whirlwind, and everyone's like in and out, in and out, in and out for a day. Then they gather up all the information, the person flies back to San Francisco or Denver, right? Because it's just so cheap to send a letter versus having someone audit you face-to-face. Now, what happens? What happens if you were to actually get a letter, right? Now, I know from speaking to people, this is typically what happens. First of all, you go out to the mailbox, you open it up, you take out your mail, you find that white envelope, has the IRS logo, top left, you freak out, you say some colorful words, I would imagine, all the way back to that front door. And then you walk into your kitchen, you open up a drawer, you throw that sucker in there and you say, you know what, it's a Friday. There's no way I'm opening that thing and ruining my weekend, right? That's how it goes. Then what happens is next week you say, oh, Monday is a big, big meeting morning. Can't look at that thing yet. I got to have a good work week. I'll do it on the weekend. No one wants to spoil the weekend. And this thing goes on and on and on until finally you get a second letter in the mail. And maybe that prompts you to open up your first letter. But if the IRS is sending you a bill, for lack of a better word, for $400, what do most people do? Most people scratch a check. Why? Because it's easy. I don't want to deal with the 800-pound gorilla known as the IRS. I want to get them off my back, and I want to do it as quickly as possible for $400. No problem. I'm just going to sign a check. I'm going to send it in. Boom, be done. Right? But that's not always necessarily what you owe or should pay them. There are tricks that the IRS does. In fact, I had someone, his taxes are done by a different CPA within our office, but typically if it's IRS related, it's going to come over my desk because I'm going to take a peek at it, look at it. I deal with the IRS a lot. I like to fight. I like to win even more. So sometimes I think of it just as a competition. But they gave it to me. I reached out to this poor young man. The IRS had sent him a bill for $1,400. Now, $1,400 doesn't sound like a lot, but for this particular person, $1,400 was a ton of money. It wasn't like he had it laying around. And what the IRS had done is, this is a trick that they always do, is that if there are gains from the sales of stock, in this particular case, it was cryptocurrency. Okay, so the exchange is on cryptocurrency, and crypto, I guess crypto places aren't the best often of relaying that information back to either the people who do it or the IRS. But this particular one was Robinhood, and they sent out your barter statement. He did not include it in his tax return. So what the IRS does, here's their trick, is they roll down that barter statement and only look at all of the proceeds. Then they make adjustments to your tax return based on just the sale or the proceeds of all those exchanges. Say, oh, you had another $20,000 worth of income. They completely ignore the cost basis aspect, even though they have the cost basis reported in that barter statement just the same as the proceeds or sales. So he comes to me and I say, oh, this is an easy one, no problem. We're going to get this thing thrown right out. So we go through, we calculate it, and he actually had a huge loss. He didn't make any money, he lost money. So now the IRS trying to send him a bill, now we're going to go get some money back for him and put money back in his pocket, right? So you always, always, always have to look at those letters. I have a nice letter for you to look at right here. This one's a beauty. This one is actually a letter that was brought into our office by kind of this couple. And they said, we don't know what to do. They were frantic. Because if you look at the bottom right, you'll see $62,221. The IRS was sending them a bill for $62,000. I mean, that's going to ruin their day. They're going to come in and talk to me. It's going to ruin my day because simply I just feel bad. I mean, I have a hard time separating emotion from clients and stuff, if I'm being completely honest. So we start looking at it and we start kind of going through it, and they're trying to figure out, what are we going to do? What are we going to do? And then, well, I just kind of do this. Fold my arms, big smile comes across my face because I can see, oh, they don't owe it. Oh, I'm gonna get them out of this thing in 2 seconds. They don't owe it. So if you look at it, what tells me that they don't owe it? I'm gonna give you a hint. What is the tax on a $400,000 loss? Zero, right? No money, lost money, don't pay any tax. What is the tax on a $245,000 loss? Again, zero. Didn't make any money, lost money, no tax. Now, think about fifth grade math. What happens when you increase a negative to a lesser negative, if you will, creates positive numbers. So all that was happening is that the computer took a $481,000 loss, reduced it to a $245,000 loss, created a bunch of income for the difference, then took that $236,000 on line 2 all the way down to where they would owe 62 grand. Right? So I realize that this may be an extreme example, but they did actually bring this into our office. But the point of it is, just because you get a letter doesn't mean you owe it.
Joel, one question.
Yeah, go ahead.
Did you then return an invoice back to the IRS for $62,200?
I did not. No. So we ended up just writing letters and putting the documentation together. I mean, that would have been good. I would have liked to. Actually, I'm more excited about the other guy who, regardless of the amount of money, that the IRS said, hey, you owe me $1,400 and we're going to go back and say, no, you owe him $400. right? That kind of thing gets me really excited.
Yeah, the
When
fight.
when they pull that kind of nonsense. But the way that they've kind of, the law that is written over the way that the letters are being distributed. So you'll get one letter about, I don't know, maybe 2 or 3 months. You'll get a second letter. Maybe another month or two goes by, you'll get that third letter. That third letter is what we call a letter of deficiency. And that letter of deficiency is what puts people on notice. And from that, you'll have about 90 days to either clear it up with the IRS or go to tax court, or you're going to owe it forever. So when those people, not wanting to ruin your weekend or your work week, and you throw these IRS letters into the drawer, I just want to caution you not to do that, because had they not brought this in, which is clearly something that they don't owe, and they waited, second letter of deficiency, 90 days passed, still didn't clear it up, there would have been nothing I could do about it. So from a clerical error, they would have owed $62,000 because it follows the law, right? Because they always have to follow the law, and they write the laws into their favor. So just be aware of it. Okay. Just be aware of it. This isn't trying to make you nervous. What I'm trying to do is like bully you up to say, hey, take a look, right? Just because the IRS says you have to do something doesn't necessarily mean that you have, that you owe it. So I want to go through a couple audit tips maybe. Realize that if the IRS thinks you enjoy it, like for me, cars, right? So if the IRS thinks you enjoy it, they're going to look more closely at it. So trips, meals, cars, maybe some tech, those types of things that you're writing off in your tax return, those are easy places for the IRS to look and say, is that really ordinary and necessary? So it's not that you should be putting those things inside your tax return. All this stuff just comes down to support, documentation. Okay, do I have proper documentation for what is going into my tax return? And that falls directly on the head of the business owner. Okay, that is your responsibility as a business owner to keep receipts and records of what goes into your tax return. Okay, I'm often asked, so great, I use my Amex, and I'm really excited. They push a nice little statement to me every year. It says I went to Walmart yesterday. I spent $250. I'm going to write that off inside my tax return. Is that credit card statement adequate support for your particular tax return? Well, the answer is no, most of the time. Okay, and generally speaking, it is not. Why? Because while there's a $230 charge from Walmart, I could have gone to Walmart and bought bananas, men's underwear, some jeans and a t-shirt. Oh yeah, then I happened to go over to the electronics section and I bought a computer monitor, right? But the credit card statement doesn't detail out what I actually purchased. It just gives you a nice lump sum. And we have so many of these kind of big box retailers now, Amazon included, right? That just shows who you paid, not what you paid for, right? Not what you paid for. And that's what we need. We need the detail, right? We need the detail. So what do we do? 'Cause I definitely don't want to keep, boxes and boxes of paper for how many years? 7, right? 7 years for all that time, and store it. And, I don't have any place in my house where I'm supposed to go get a storage unit for all this nonsense. So we have to use technology to our advantage now. So while I use Amex Business, Amex is wonderful enough to create an app for me that as soon as I go charge something, it appears on my Amex app, lets me attach a picture to the charge. So I just take a photo of that receipt, I crumple it up, I throw it in the trash, and Amex is kind enough to keep that for 7 years. However, which I download everything, each quarter. So I have all those copies of those receipts, but they keep it for 7 years up in the cloud for me to go back and utilize. Think about if you live in like Arizona or Texas or Florida, something in the middle of summer, you get a receipt, you throw it in your car. By the time you roll into the gas station to get a Diet Mountain Dew, 44 ounces, you go back in, that receipt is gonzo, right? Half of it's already gone. So we have to use technology to our advantage for proper documentation, because that is what allows us to put those things inside of our tax return and get the deductions that were warranted and pay less in tax, okay? So use technology, whether it's Excel, QuickBooks, whatever it is, to your advantage. Okay, so I'm going to close this out with just a couple takeaways. First takeaway is, and then we can get to questions that you guys may have. So first takeaway is just be smart about how we plan. Okay, We need to be aware of our tax environment. We talked about kind of where we think our effective tax rate is. We made some of those examples at the very beginning of 20%, right? So what's my tax environment? If I go buy, my tax rate's at 20%. When I buy something, I know I get a 20% deduction on that specific business item. Again, we're team stacking now, right? Don't do what we did at the very beginning. Team stack your business that allows you to do what it is that you want to do, after all, and how it is that you make money. So, put some strategic partners in place that will afford you to do that. And then finally, I want you to kind of understand how taxes affect your business from a write-off perspective. Are we deferring it? Are we connecting it? Are we spending money? Are we using retirement plans to our advantage? So just be smart ways to plan in general of kind of how we view things. Secondly, I want to use some common sense. Okay. The neighbor across the street that has, a 26-foot nautique boat, drives every nice car you can imagine, side by sides, pool in the backyard, 10,000 square foot home, and then comes and tells you, man, I haven't paid taxes in 10 years. Let me give you some advice on this. Okay, I'm going to tell you two things are going on. Either he's lying or he's lying. Okay, so let's use some common sense of where we get our instruction and how we come across and get instruction from a tax perspective. I also want to say, I'm not going to throw my fellow peers under the proverbial bus, but I think it's an unfair statement to say that tax preparers aren't created equal. I think the fair statement is not all tax preparers choose to practice in all areas, right? So much like a lawyer may choose to practice in a specific area, CPAs kind of work the same way. I may be a CPA that, based on my client base, I simply want to deal with people who have earned income credits, or kids. I don't want to deal with businesses, or maybe a small Schedule C or something. I don't want to deal a lot with depreciation or real estate. I don't understand the real estate rules of betterments and so forth like that. So just be aware of whoever your tax preparer is. Try to find someone that has a background or familiarity with what it is that you do and how you make money. And finally, I'm going to say, man, if you're a business owner, you got to act like it, right? You got to act like it. I mean, it's amazing to be a business owner. It is very rewarding and self-gratifying and everything else that comes around with it. But as being the business owner, I have to put things in place. I need to know my financials. I need to know what they are. I need to be aware of my tax due dates, May 17th again, by the way. Make sure you get your extensions in if you don't want to file by then. Right? So I got to do all those things that you would expect a business owner to do. And that's when you're going to have the most success. And especially from a tax perspective, getting those numbers straight, that's when we're going to be able to do our best work when it comes to that. And finally, I'll just put this up. We do partner with Kevin, and I do appreciate your time on getting me away from doing some compliance work for about an hour and a half. This kind of stuff is actually fun for me to talk to everyone. But if you want to talk to us, at least, maybe get some advice on your particular situations, because I kind of talk in generalities, because everyone's tax situations. Have you noticed whenever you go to and ask a CPA a question, the first words out of their mouth will be, well, it depends, right? It depends. Can I write my car off? Well, it depends. Because tax situations are so different. Then you have to go through the conversation of, okay, explain to me what's going on, what you're dealing with specifically, and then I can probably give you a better answer. But that's where you can get a hold of us if you so choose. But I do appreciate it. Now, I guess, Chris, we can open up to some questions or further discussions on what you may have.
Yeah, that was great stuff. And I know, I can tell by the sheer amount of chats and questions that came in, like the hot topics, and then some of them were crickets, but the car one, holy smokes. I mean, you're a car guy. I love cars.
Yeah.
That was a popular thing. So there's a lot of questions on that. And the way you ended that with, if you're, a business owner, act like it. And I always say the same thing. If you're going to be the bank, treat your money the same as you would treat the bank's money. It's kind of the same thing. It's really just a mindset. You got to get your mindset right before any of this stuff can actually work. So there's some great questions. If you're ready, we'll dive right into these. So Cynthia said, is there a requirement to declare a one-time large sale or personal property, i.e. a diamond ring, like if somebody had like an expensive, diamond ring or something, is there a requirement to declare that large sale?
Yeah, it depends on how much money you make. Because they always like to say, well, if you're making money, then that's income to you. Therefore, you may owe some tax. Lots of times when we're dealing with diamonds or jewelry, they can be investment pieces, just like anything else. Watches, paintings, some of those, kind of high dollar volume items. So yeah, oftentimes even from a purchaser standpoint, if you're going through a business, they may even report it for the sell aspect back to you when you're dealing with. I mean, when she says it that way, I'm just expecting it to be a very high dollar net worth type of thing. So
yeah. And then that same person asked this question, so I'm just going to scroll down and hit this one. Is there an income level where the IRS just doesn't bother you?
actually, no, there is not. You would think that there is. So let's say that okay, so everyone says, yeah, millionaires get audited every year, and this is true. They do get audited more often, and that's largely due to the fact that they just are in the highest tax brackets. So if I can go in to a millionaire and I can just find a few changes that I can make within a tax return, well, then I'm going to be collecting a lot of money. And so therefore you would think, oh, hey, you know what? I make about $35,000. I got a couple kids. The IRS isn't going to bug me. But then what happens is all those earned income credits start to creep into play. Now the IRS is paying you money. In fact, you have a few kids, you may actually be earning money from doing your tax return, but then they do come through and they do look at that. I've actually had the IRS look at things that are what I would call just nonsensical, with a Schedule C that someone had $8,000 worth of income and about $10,000 worth of expenses. And sometimes that is simply luck of the draw, that they just draw some of those out. They do have what we call a small business kind of group within the IRS that only looks at things under 100 grand. That's all they do. And I actually dealt with one of them just I don't know, a couple of months ago. Actually, they sometimes are much easier than some of those high dollar people, but there isn't. And so no matter how much money you're making, I would always say it's the documentation that you need, it's the support that you need that kind of safeguards you from I was just thinking of something from the IRS. Let me throw this out there because it just popped into my mind from that question. Okay, so the IRS is turning to these audit letters, right? And they're sending those out now. Lots of people, most of my clients have businesses, and meaning 1065 LLCs or partnerships, 1120S, which is my S corporations, or 1120, which are my corporations. Okay. So I'm going to segment these groups. I'm going to say all my business income tax returns, LLCs, partnerships, S corps, C corps, right over here. Individuals over on this side. So my individual tax returns on here. So out of all the IRS letters I have been given or seen, let's say over the last, I don't know, since the beginning of time, how many do you think were addressed to individuals, and how many do you think were addressed to an LLC, S corp, C corporation, or partnership? What do you think that relationship is between those two when it comes to audit letters specifically? Not audits, audit letters, which the IRS, by the way, was at about 71% of the time during 2018 from pushing the audit letters. I'm waiting to go back. They have proposed stats that are just coming out for the New Year's, but I imagine that that's going to continue to creep up because my percentages are the same. So if they're sending out these IRS letters, and that's kind of how they're liking to audit for the most part, right? What do you think the relationship is? Who is receiving these letters? Individuals or all these businesses where they're all making this money? I'll just tell you. Of all the audit letters I've looked at, everything that's been given to me since the beginning of time, 100% of them have been addressed to individuals.
Oh, wow.
All of them. So what does that tell me, right? And within the firm, we have, a large enough kind of subsection of clients that I think I would see something being addressed to those individuals. So let's say I'm going into business, and I'm excited about it. All those things, IRS, yeah, it's in the back of my mind, but I don't really want to deal with it. If I were to say, hey, take out let's call it an insurance policy, right? Kind of, if you will, if you'll give me that latitude. Against IRS audit, what's the first thing I do? First thing I'm going to do is set up a company. Very first thing I'm going to do, because I know from the letters that I see, if I can push that the operations of that company into a 1065, 1120S, 1120, one, it gives me more latitude from ordinary and business standpoint, right? And how I'm going to interpret section 162. And I know that the chances of you getting an audit letter for those particular entities is so far removed from having that included in your individual tax return. It's just worth the effort and the extra dollars it takes to try to keep the IRS off your back from a yearly tax compliance standpoint. So I always find that interesting, that dynamic. And I'm still waiting for that audit letter to go to a business, but I just haven't seen it yet.
Yeah, that was a great takeaway there. Felicia said, when I retired, I took out all of my money from my 401k and I used it to upgrade the house. So now I have no tax shelter other than holding the stocks for over a year or not selling at all, which is not realistic option for me because she wants to buy low and sell high.
Mm-hmm.
How else can I save on capital gains tax?
Yeah, so it's interesting with capital gains like stocks and so forth, really, they don't allow for deductions anymore, right? So I sell something, boom, I make 100 grand off of capital gains, it's $100,000 that's going to go into my tax return. Thing to remember though, when it comes to capital gains is there is a pecking order, okay? So what that means is that capital gain income first can go against the same type of capital gain loss. Let's say I have long-term capital gain income. First, if I have any long-term capital losses, right, I can marry those two together. So really, if I needed to sell something to make a bunch of money, and then I just have a dog stock that you just, this thing is never going to come back, you might think about selling it at the same time just to be able to offset those two, right, from a gain and a loss perspective to reduce the amount of tax that you owe. Then those gains will go against short-term losses or those stock losses, even that I've held less than a year, right? So if I have no long-term losses, but I have short-term losses, now I get to offset those. And then if I still don't have any of those, the pecking order then goes towards ordinary business losses. So let's say I was operating or had a business on the side, and this isn't a cash flow remark, but let's say I had losses. And you can have losses for all sorts of reasons that are not necessarily tied directly to cash flow. So I can be cash flow positive, but tax negative. Okay. So let's say in a specific year, I was cash negative based on how I was operating my business. Then that loss could then offset some of that capital gain income that I have. So there's a pecking order on how that does. And really what it comes down to is trying to tax plan a little bit about the timing of when you decide to sell something versus everything else that's going on within kind of your business world.
This question is a good one. It's, what is tax loss harvesting?
So so I guess it depends on who you talk to, but I'm going to assume it could be what we call carry forward losses. With specific businesses, there are rules when it comes to losses. They don't have gains to offset them, but they just roll forward. Okay, real estate is a perfect example. If I make enough money and I have all these losses from rental real estate and I can't take those losses, then those losses will roll forward. And I may be able to accumulate those year over year over year over year. Then when I get to a spot and I have all these losses that have just rolled forward for a decade, now I'm going to sell all of my real estate and I'm going to apply all those losses to all the gain that on my real estate, and it just drives down my tax. So I'm going to assume that's what they're talking about. Really, it comes down to kind of loss carry forward and how you implement that against gains and kind of how the timing of that all works out.
Yeah, it's exactly what I did when me and my wife were flipping a lot of houses. We were up to 20 a month. At the end of the year, we'd have our CPA look at our tax situation and say, okay, you're going to owe a lot or you're not. And we would a lot of times take and dump a ton of money into properties at the end of the year to increase, the write-offs that we had. And a lot of times we would defer the sale of a house to the next year, do a lot of capital improvements or repairs. A lot of repairs is what we did at the end of the year. And then I also just, when I was an advisor, a lot of the things we would do is we would review a lot in the fourth quarter. And if clients had big gains, we would take a lot of their positions that maybe were at losses and we would sell them. And that was tax loss harvesting.
That's right.
We would just use those carry forward. So me and my wife, we had a very large amount of losses in our real estate business because of the way we operated. So when we started selling off all of our rentals like we are right now, we've had all these losses to apply to those gains that we're seeing. Now, obviously it's not a perfect strategy, but it certainly helps. So I think that was a great question. Eve said, if I have a W-2 job in one rental property that had a loss, does one still get the 20% off?
Okay, good question. So it's interesting because that 20%, right? The qubit that I talked about. Again, we have to deal with words. I'm sorry about that when it comes to the IRS, but they use the word qualified. And in the tax world, when you say qualified, to me, when it comes to income, that is income that is subject to self-employment taxes, or what we term active income. Now, the beauty of rental real estate is that it kicks off passive income. What does that mean? That means I don't pay self-employment taxes on that passive income. But the qubit in and of itself talked about qualified income. So I waited 14 months for an answer. 14 months. Now the IRS was really quick about it, right? 14 months, to the point that I was actually doing tax returns and I still hadn't gotten an answer. But finally, the IRS came out with what is called the safe harbor rule when it comes to rental real estate. You can just maybe even Google safe harbor rule rental real estate. And what it allows you to do is if you have income from passive real estate and you meet specific qualifications, that 20% will apply to the income that you make. So yes, it can apply to that income. The biggest qualifier is an hour requirement that you need to spend within your particular real estate rental that you have. And that's 250 hours, okay? Honestly, when it comes to real estate, I do real estate. I own commercial buildings. I do flips also on the side. I just think it's fun. And 250 hours to me is, super easy to get within a given 365 days. So yes, it can apply to you as long as you meet some specific criteria.
Okay. And then let's see where it got that. So that one kind of flows in. This one says, if you're not self-employed with no LLC, but make money from renting vacant rooms in your house, can you benefit from the qubit?
Yeah, so same principle. Yep, same principle.
Okay, great. Wow, listen, I got one right, folks. Chalk that one up. All right. Joanna said, are there any business types excluded from taking the qubit deductions?
No, no. So really, I'm not getting into all the detail of the qubit, like there are income limits and there are assets play a factor, payroll plays a factor, all those types of things. But generally speaking, as long as I have income, self-employed income, the type of entity is irrelevant.
Cynthia has a good question. We see this a lot in real estate with the wrapping of cars. So if you have advertising on your family car, is it 100% of the mileage, or is 100% of the mileage deductible? I mean, if you're driving around a poster, I mean, can you write all that?
That's a great question. I love that question. In fact, it was probably back in the, I want to say maybe 20 years ago that that kind of strategy was heavily implemented from an advertising people trying to up the amount of their car that they can actually write off. So that particular incident happened to flow through some court cases dealing with that particular subject, and the answer is no. It does not change the usage of the automobile, having it wrapped in the name of your entity.
Wow, I think there's a lot of people that have bad information about that.
Yeah. So, but here's what I would say. What I would say is, one, write off the cost of the wrap, right? Because that is advertising. Okay, so you write off the cost of the wrap. Two, then you just come back and say, okay, now I'm really going to take a viewpoint of the miles that I'm driving from a business perspective. And, if I am driving, let's say there's a football game. I go park my car in front of a football game because I want everyone that's walking out to view my car, read what, the wrap that I have on it, get some ideas, then I drive my car home. Well, I'm going to write that trip off, right? So really, instead of focusing on, can I write my car off, focus on how I'm using my car to benefit my business and then deduct it that way.
Interesting. Then Rhonda said, I'm in the insurance benefits business. I currently use the actual method but I also lease my car. Now, post-COVID,
Okay.
most of my work is at home and less in the field, even though I can still write off some months of my lease. Is it better to buy now or continue to lease? So yeah, I mean, basically if somebody leases their car because they were driving, for work, but now they're not,
Mhm.
what one's better to do?
So when it comes to purchasing car, oftentimes what I like to say is decide from a cash flow perspective how you want to buy the car, and then let me come on the back end and figure out the best way to write off that car. So even if I lease a car and you're not driving it as much, you're still driving it for business. So the same ratios can apply, which means I can still write off my payment, right? So that's how I would look at it. I'm always going to follow kind of the function of the item and how I'm using it. So even if you're driving less, let's say now you only drove 5,000 miles instead of 15,000 miles. Well, you may still have that same business relationship with the lease, and I'm still maybe writing the cost of that lease off. I will let me divert just something I think is funny about leases. So IRS has what we call luxury car limits. Okay. And they've kind of modified them a little bit. And it's not till recently when they've gotten to leases and kind of using this $50,000 deal. But the IRS, from a luxury car limit standpoint, if you can believe it, up till very recently said any car over $19,000 is a luxury car. And I don't remember the last time you could lease a car for under 20 grand. I'm sure it's out there somewhere. Maybe a VW Jetta, bare boned, stick shift, manual windows. Yeah, so that's kind of their viewpoint. They're just saying everything's a luxury car. So, but when it comes to leases, sometimes there's some add back provisions if your car is expensive enough. So I would just sit down with your tax person and go through it. But again, for your lease, yes, still write off the payment the same as you were before, because I imagine you're still driving basically ratio wise the same as you were before.
And Rhonda, I got to throw in a shameless plug. There's no better way to buy a car than with your own bank and getting all the money back for every single car you're going to buy, drive, and own. So I'll just throw that one in there. Maureen said, I heard that there's a new government grant program where you can get an electric car, which is a huge thing right now, or an electric truck for 65% off as a small business owner. Do you know anything about that?
So I haven't heard the 65% off. No, I'm unaware of that, because if that were the case, I'd be trading my Tesla Model 3 in for a Tesla Model S and putting money down on a plaid version that will be out later this year.
Wow.
What I will say is there are tax credits. So when I bought my car, I could write off $7,500 not write it off, but a $7,500 tax credit. Depends on the auto manufacturer and how many they produced and where that credit may lie within their specific automobile run. Now, I am hearing that tax credits from an electric car standpoint are going to be coming back with the new administration in Washington. So I would be looking out for the type of tax credits you can get off of electric vehicles. In fact, I've also was reading that electric bikes are also going to fall into that foray, that you can get a 30% tax reduction up to, what was that number? I think it was $5,000 for $1,500 tax credit or something like that for buying an electric bike, right? So they do have a lot of electric incentives that I'm seeing that are going to be come out. I don't know if they're quite out yet, if they pass that from an act standpoint, but I imagine as they most likely, I'm going to hedge there, but I'm going to say most likely change the tax code as we kind of move forward. A lot of those credits are going to come back into play.
Yeah, I mean, that seems to be the way it's moving. I mean, Cadillac, GM going all in on electric. So something's got to happen.
Yeah.
Debbie said, could you explain moving mileage? Is it moving from one state to another for personal or business? She said she's moving from Michigan to Texas.
Oh, yes. So Michigan to Texas. So mileage would be from your place where you are now to your home in Texas. Yeah, it's just a straight shot. Google it and it'll give it to you.
Great. Yeah, that actually makes it super easy. Let's see. ME says, due to cancer, I'm unable to have children. Okay, we're considering surrogacy, which costs about $100,000, which we're wondering if you could write this off as a medical expense and not risk a tax audit, even though the average medical write-off within my AGI is 10,000.
So I haven't had a surrogate. I haven't run across that issue personally yet. The thing that I would always remember when it comes to medical expenses is that if it is a qualified medical expense, then it simply would go into your Schedule A as part of your medical expenses, and you would get a portion of it depending on how much money you make and the, kind of your flooring that they have when it comes to medical expenses. So, and again, it's not the dollar amount that should make you nervous. It's the support that you have on the back end for your bills and everything that you're paying that you should worry about more so than how much from a dollar perspective that goes into your tax return. I always like to tell people, don't worry about the dollar amount. If you have to support the dollar amount, it's kind of irrelevant.
Okay. Tracy said, my husband and I both work from home. I run a rental business out of the home, and he runs an IT company out of it. This year, we received a 1099-S from the utility company that needed our land for right-of-way. The amount was $50,000. Can you give me any advice on how to direct my CPA on how to handle this? He initially thought we needed to add it to our income. I've been doing some research, and I don't feel like that is correct. And if that's not correct, time to find a new CPA. I just put the link there to schedule a call.
Yeah, so typically with 1099-S's, what the IRS will do if you don't include it in income, you're going to get a nasty letter. Okay, so that's the reason that the IRS requires 1099s in the first place, is that they want to know money that is exchanging hands and where they can go after it. So my thing would be, it's not necessarily I would look at any basis issues that I could have to offset some of that income. For easements, I haven't looked at easements specifically, but if it follows kind of function of other 1099-S's, I would look at basis or what I may have to be able to offset that and reduce any tax that I may owe.
Okay. And Colleen said, could you please expand a little more on the line between hobby and business? I'm a part-time artist with a full-time job doing something else. I do derive some income from the art, but buy a lot of art-related supplies. This is pretty common.
Yeah. Okay, so I'm sure everyone's heard of the 2 out of 5 year rule, right? They say, oh, if you've had 2 years of profit out of 5 years, then you're a business. Well, I'm here to tell you that that thing is absolutely nonsense. When it comes to the IRS and actual audits, like going through the process of supporting a business, regardless of whether you're making or losing money, they don't look at the 2 out of 5 years. They don't care. What happens is they look at what we call profit motive. Okay. Am I doing this for profit? Right? How many hours am I doing this per year? Am I changing things year over year based on how my last year turned out? For example, if last year I lost $5,000 based on how I was operating that business, am I doing anything different this year to try to make money instead of simply losing $5,000 again? So what happens with the hobby business versus hobby rules, it is not one particular item that says, yes, I'm a business or yes, I'm a hobby. They follow how you act, how you operate your business, what your motives are. For example, if you and I were in business and every year I came to you and said, hey, you need to pay me another $10,000. We didn't do very well. The next year I come and say, hey, you got to pay me another $10,000. And by that third year, you're like, I'm not paying you anymore, right? Unless you change something or do something different. So think of it in those terms. What are you changing? How are you different? Do you actually have a profit motive? Are you trying to make money? That pushes it to the business side rather than from the hobby side. And the real difference between the two is that a business allows me to go negative in years, where a hobby can only reduce me to zero and get rid of my income.
Yeah. And then Boris, we covered this a little, but it's good recap. He said, do you need to keep receipts for meal expenses?
For meal expenses, that's a good one, actually. So we know, so for 2021 and 2022, meals are 100% deductible, okay? So they've changed that. It used to be 50, now it's 100% for these next 2 years. I mean, really, it's pandemic related. They're trying to support restaurants and keep people buying meals and so forth from them. So I actually think it's a great thing. There are two ways you can do. Oftentimes people talk about that $25 limit. Hey, if my meal is under $25, I don't need the receipt. And while that is maybe technically accurate, what I'm going to tell you is that it's going to be based on the IRS agent that you deal with and whether they accept that rule or not. So as a general practice, I would say keep all the receipts that go into my tax return, regardless of the amount that it is. If you were to use, like I go back to my Amex business, if I have any app, there are lots of apps, TaxBot, all these kinds of things that will track your credit cards and what you do, and just attach photos and then throw that receipt away. You don't want to have to deal with it. But we do have to keep them 7 years. 3 years back are always the most important, but we do have to keep them for 7 years. But the other thing you can do when it comes to meals is that there's per diems that are set forth by the government. So let's say I was traveling somewhere and I didn't want to track my meals at all. I'm not going to deal with it. Let's say I was going to Buffalo, right? So let's say in Buffalo, they're going to give you a per diem amount that I can spend on breakfast and dinner. They assume everyone has to eat lunch regardless. So breakfast and dinner, and how much I can spend even on a hotel, right, for lodging. And let's say it's $20 for breakfast, $40 for dinner, and it depends again on where you're at, and it does change drastically depending on where you're at. So that gives me $60 per day for meals that I can write off. I can do that and not keep a receipt because I can document I was in Buffalo for these 4 days, and so I'm writing off $60 per day for those 4 days that I was there, and I'm no receipt needed. So there are two different ways you can kind of do and manipulate meals. Like if you like to go to Taco Bell every day and spend $12 a day, take advantage of the $60 per diem amount. So it all kind of is manifested by how you like to operate.
Okay. So if somebody was away on business, can they claim meals for every day they're away?
Absolutely. Yep. Absolutely.
All right. Let's see. This one's a good one. I rent one property out and I have both my properties and car in my business name. My CPA this year suggested it might be better not to do that this year. She doesn't know though. So we'll look into it in summer. Okay. Yeah. So I guess
So both are properties. Okay. So I'm going to assume a couple of things. One, this is just me personally, I would have my primary residence. I would not have that in an LLC because I would want to take advantage of the exclusion rules to gain for primary residences, right? If I've lived there 2 out of the last 5 years and I'm married, I can get a $500,000 exclusion on gains. And with what's happening with home values now, I absolutely want to take advantage of selling my house if that's what I'm doing and not having to pay tax on it. If my primary home, is owned by an LLC, it changes everything. Now it's basically a business property. It's not my personal home. I can't utilize those rules anymore. So I don't know about your particular kind of setup, but I would look at my primary home. I'd rather use trusts and different things like that for a primary home rather than an LLC. Car, fine, no problem. The rental property, awesome. Yes, put that in an LLC. But from a primary home perspective, I'd want those exclusion rules. So
that's one where you'd want to book a call and really kind of dive deeper into that.
Yeah.
All right. Samuel said, I owe some back state and federal taxes. So I get calls every day from companies telling me they can negotiate this debt down. Is there really any tax forgiveness or special tax forgiveness due to COVID?
Okay. Due to COVID, from an interest and penalty standpoint due to COVID, yes, you can get some easy forgiveness from that. From a tax perspective, sometimes you have to negotiate with the IRS, but oftentimes that's based on length of time. IRS isn't going to negotiate anything for last year. It's too recent. If you owe something from 8 years ago and you haven't paid, and the IRS says, hey, okay, we'll negotiate something with you now because they've gone through all the collection statuses and maybe they've tried to get money from employers and wages and all those things, and they just, even from their end, have hit a dead end, then maybe they'll negotiate a little bit more. And then oftentimes with third-party companies, usually it depends on how much you owe to whether or not it's worth getting them involved. Their fees typically are fairly expensive. So, if I don't owe, $50,000 or more, I'm probably not going to look at them. I may rather get in touch with a good CPA and just kind of pay an hourly rate and maybe have them interact with the IRS on your behalf. That might be a cheaper way to go.
Yeah, that's how I've done it, because I've gotten a lot of letters from the IRS, and I'm not that guy that gets it from the mailbox and then puts it in the envelope. I open it, it ruins my entire weekend, And
Yeah.
then I get on the phone on Monday and, with somebody that knows what they're talking about. And I usually feel a lot better, but it does waste my entire weekend. Why is it that we always seem to get the IRS letters on Fridays? I'm telling you, there's something
I don't
to.
know, but I think there is something to it when they mail it out. Absolutely.
Yeah, I definitely agree with that. Carrie said, do you know about international tax? So we'll start with that part first.
So I'm not, let's say this. While I do have some international clients but they're not US citizens. They're actually foreigners that then operate inside the US. So I'm familiar with US taxes. I'm not as familiar. I'm somewhat familiar with Canadian taxes, but not to the point where I would want to do a Canadian tax return.
Okay. Yeah. So Carrie, you might want to defer that one because Carrie's a UK resident,
Okay.
and she's got some questions about reduced pensions and early, taking the money out early. So
Okay.
yeah, we're going to push that one.
Yeah.
Anonymous said, what was the line item I should check again to see if I got Cubid?
Yeah. So it'll actually say qualified business income deduction. So that will actually state that on the line. So 2018, it was I think the top of page 2, 2019, bottom of page 1, and then this year again, page 1. So it'll say, you can just go line by line down and it will say qualified business income deduction, and it will happen just before your adjusted gross income.
Cool. Cynthia said, are there any tax incentives for solar roofs and e-vehicles? We kind of hit the e-vehicles.
So solar roofs, those go in and out, in and out, in and out. So there have been in the past. I'd have to check for like 2021, for example. I haven't looked that up yet, but just be aware that they tax credits for furnaces, windows, geothermal, solar, when it comes to a primary residence, actually expire and change. So I've had people put in windows during the 1 year it had expired, then they enacted it the next year. So I would always say, I just haven't looked that up this year, but probably do a quick search to make sure that it is in place for 2021 before you do anything. If the tax credit is a requirement for the replacement of whatever it is, or the inclusion of solar.
Okay, let's see. Next question is Mary. How can I incorporate my children in my business with tax benefits? If I'm employing them, can I write off cars for them too? That's a good question.
That's a good question. So the IRS actually looks out for that, just so you know. And then what they call is income shifting. And income shifting is when a parent that is in a high tax bracket tries to simply shift income to children in a much lower tax bracket. For example, oftentimes that will happen with business owners. They have a 5-year-old or a 6-year-old kid and they're trying to throw them $20,000 a year. That typically does not work. So, that doesn't mean, however, that you can't pay your children something. And the way that you typically would do that is you would figure out at what level of service can the age of the child actually provide. Okay. So I have a 12-year-old, for example. Now, if she comes in and she cleans the office and she does sort of think, well, she can make some money. Sure. And I can pay her and I can push some money to her. But I don't think I could pay her $30,000 a year for coming to my office because that isn't congruent of what I would do at an arm's length transaction, for example. But yes, you can do some of that. So I would always say, hire your kids, pay them something that would be proportionate to what you'd be hiring someone else to do based on their age levels. And you can push things over to them just like you would do with anyone else. Then on their end, what I would do is say, okay, if I have a 16-year-old, from a car perspective, I would probably look at miles. If they're making $10,000, $15,000 a year, and 16, they could make $20,000 a year. Does that warrant a $30,000 car write-off? Maybe not, but you can probably put in miles and all kinds of expenses then from their side to get rid and shelter as much income as possible. So it kind of depends on the child, their age, what they can do, what your business is. But yes, definitely you can do something.
Peter, another car enthusiast, said, can you write off more than one car per year, or are you limited to one car? Meaning one car for me, one for my wife, of course, for business reasons only and through banking policy alone.
Yeah. So I will say this: if you're a single owner LLC, for example, they may question, why do you need 2 cars? That doesn't mean you can't have 2 cars. They just simply mean they may question, why you have two cars. And if each car has 18,000 miles a year on it, then they may question how in the world are you driving that many miles per year, right? So that doesn't mean you can't have two cars. You just have to be smart about it. First of all, I would add your wife to your LLC, kick that thing out, have a separate tax returns, make her active to maybe even a 10, 15% ownership of the company, and then try to put the two cars in and get some of her usage on the second vehicle and try to do it that way. So yeah, you can just try to be smart about it. You know what I mean? Pigs get fat, hogs get slaughtered, right? So just don't go with the hog mentality, go more with the pig mentality, and typically you'll wind up a lot safer.
And Peter, if you ever do get a letter asking why you have two cars, just say one is for when I feel like going really fast, and the other is one for when I feel like being practical, and see what they comment.
Right.
And then just quote something from Talladega Nights and the whole problem will go away. So Magda said, I have clients that own a corporation and their CPA told them to pay themselves with a 1099 and have the corporation show that they did not make any money so they can buy a house. And now they tried to purchase the house and the bank told them that they need to be qualified with both income, personal and business. So it hurt them more than helping them. What can they do at this point on?
Okay, so when it comes to buying a house, especially now, because lenders are kind of
Tightening up big time.
Tightening up big time, yeah. So they do look for qualified money. And the best way to get qualified money is through a W-2. So I never would have told, if you had a corporation like a C corporation, I never would have told someone to 1099 yourself. Because what will happen is then the bank will look at 1099 income as self-employment income. And I imagine that if their tax guy said, hey, I just 1099, because tax people like me and banks, we do not get along, okay? We do not see things the same way. My goal is to have you have as little income as possible. The bank's goal is to have you have as much income as possible. So what I would have done is say, hey, if you want some qualified income in the year you're going to buy a house, don't 1099 yourself, pay yourself a high wage. They'll use that wage or that W-2 as the qualifier for your home. And if you're 1099ing yourself, now they're going to look at self-employment income. Now they're going to look at back 3 years and how you've done it, how much money you made. It's going to change the whole landscape of kind of trying to buy a house. And that's also a great way to do things when you are self-employed. If you know, rather than, you know, to say, hey, I know I'm going to buy a house next year, so I'm going to just set my W-2 of what's going to qualify me. And that's the year I'm just going to pay myself a W-2. Boom, I've qualified regardless if I lost money the last 5 years, right? Because that W-2 is what's going to qualify for me the house. And then the next year, once the house is bought, I go back to my normal scenario.
And as she said, but if you're more than 24% of your business, you can do a W-2. The lender told them, so what to do at this point? I would say get on.
Yeah, W-2. I mean, that's going to be a tough one. Because you're trying to retroactively fix something, you know, that's already been done. So especially when it comes to lending, what I would say is I would simply talk to a few banks. I would roll out kind of profit and loss statements and show how much cash flow is actually coming in, giving them the tax return and then explanations of the tax return and how the money was spent, especially if you have non-cash items inside there like depreciation. So it's going to be harder to get the loan and it's going to take a lot of explanation. I would just probably try to visit multiple places till I found someone that understood what was going on.
Listen, I can comment on that just a little bit. I just went through this. So I'm heavy 1099 income. Most of my income, you know, comes in 1099. And, you know, for any of you that know me, I don't talk about what I make, but it's enough. And we're buying a new house. So we went to apply for a mortgage through a mortgage broker thinking, oh my God, like this will be a breeze. And it wasn't a breeze. The mortgage broker came back, said, wow, this is really difficult. I said, what do you mean? Like add up those 1099s, there's a lot there. Plus I had some W-2 income because I do take a salary, but the only thing this mortgage broker wanted to focus in on was that $5,000 a month in salary I take from my company. That's all they cared about. It's the only thing they would count. None of the 1099, they didn't care. They didn't want to see bank statements. That's all pre-2008. So Magda, the only thing they'd be able to do is find a lender, and there's only a few out there that will lend on stated income, because there's some that still will, which be bank statement deposits, 1099, so on and so forth. But unfortunately, they're not going to like the rate. When I got my quote back from this mortgage broker, it was 8%. for a primary residence.
Wow.
I found another bank that we had a relationship that did the mortgage at 3.75, but that might be their only option. I didn't mean to kind of go in on that, but I literally just had that happen. So it's very real.
Here, I'm going to bring you back in. I'm going to make you big. There you go.
There we go. And I'm about to finish off my basement. Do I have an issue? Let's see. Do I have to issue all contract? Oh, I can't believe this is the first time this came up. I'm about to finish my basement off. Do I have to issue all contractors with something before they even start and receive it back, like a 1099 at the end of the year? So this is kind of referring to like, how do you handle contractors so that you don't, at the end of the year, have to chase them down and they won't sign a 1099, they won't sign a W-9.
Right.
So,
most of them will not. So if it's my primary residence, just don't worry about it.
Yeah.
Because it's not a business, I'm not deducting it, right? Just gather all your receipts, keep them in place. In case you ever move out, you want your cost basis established if you decide to turn it into a rental, for example, at some point. If it is your business, that makes it, and you're building a rental property, that makes it a little harder. And I would just say simply do the best.
Yeah. Jennifer said, regarding the income W-2 versus 1099 issue for home buying, wouldn't you have to be an S Corp to elect a paycheck W-2? I'm a sole proprietor currently. How can I just decide 1 year to pay myself a paycheck and not a 1099 income? That's
okay.
good.
So S Corps do require payroll. That's probably why she brought it up. But any owner of any company can payroll yourself at any time. Now, the reason people don't do it is simply because it costs more money, right? So that's why they avoid it, and they want to be able to have deductions against that income. And once you W-2 it, it makes it harder and so forth. But just because you're not an S Corp doesn't mean you can't payroll yourself. There's no reason you can't wage yourself out of any company you own.
That's correct. Yeah. And a lot of people just don't, because like that, they step over the dime to pick up the penny thinking they're trying to save. And then all of a sudden when they need something, too bad, you're out of luck. And the last question is, Peter, I heard in addition to shifting income to a lower tax bracket to kids, I might've said that wrong. In addition to shifting income to lower tax brackets to kids to reduce taxes, you can make your parents non-compensated partial shareholders of your corporation to minimize your taxes. Can you explain?
Non-compensated shareholders. So shareholders deal with, I would imagine that's a corporation. Because if we're dealing with LLCs, we have members, partners in partnership. So if she's talking about shareholders, she's a corporation. So and if I'm a shareholder, from a corporation standpoint, I never need to be paid. I mean, you can do wages, it reduces your income that way. It's your choice from a C Corp standpoint of whether or not you do dividends. I'm not sure if this is exactly her setup. However, I will say if you're an S Corp, if you are an S corporation that started as a C corporation, okay, C Corp makes an S election, an LLC or something that rolls over into an S election. But if you're a corporation into an S election, and you're distributing money as far as profit distributions, then that does have to follow any ownership percentage that someone's owning. You can't deviate. So if you own 10 and I own 90 and I'm going to distribute money, I got to pay you your 10. That's kind of how that system works. But if it's a corporation, then it's dividends. You can just make a choice of how you distribute money.
All right. Well, we got through them. 50 questions we just answered.
Oh, wow.
Pretty awesome. All right. So folks, listen, the whole time I've been posting up how you can book a call with Tax Hive. It's right there again. It was on the screen. So if you guys want to, just click that link, set up a time. It's obviously a popular topic and it's a very timely one. So folks, this can help you tremendously. They will find ways to save you taxes. I think you guys literally like have an offer where like, if you don't find something, but you guys definitely need to do this because this is really important. I wish I would have stopped doing, things the way that I did many, many years prior to when I actually got serious, hired professionals that knew how to do what they're trained to do instead of me thinking I know how to do it or just, thinking I'm going to save money and do it myself. It's just the wrong way. That team, what did you call it? Team stack. Team stack. I think that's a really important thing. So folks, make sure you do yourself a favor, get on the call with them, see if they can help you with anything in your personal or business tax lives. I'm sure they can. And also last thing, and then we're done because we went way over. Tomorrow we have our training, and some people are asking, is this the same training we've done before? You've never seen this one. It's brand spanking new. So tomorrow we are doing that. The link is there. It is free. And if you register, you get the recording, just like you're going to get a recording of today's training with Joel and Tax Hive. So folks, sign up for the preview event tomorrow and we'll have a ton of fun. It's 4 hours, so you can kind of jump in, jump out. If it's a topic you like, that's the way to do it. Other than that, we'll send the recordings. And I just wanted to say thank you to Joel. Thank you, Wendy, for sticking around. Thank you to each and every single one of you. I can't believe we still have 82 people and we're 30 minutes over the time that we put on there. So thank you all for spending time with us today. This is an important topic and I'm glad you saw it as serious because we had well over 100 people on. So that means you're ready to rock. So book your time, book your call, and see if they can help you. And other than that, folks, until the next time, actually, I'm sorry, until 4:30, because today, 4:30, we have our happy hour, Ask Me Anything. You guys can join us and we can answer more questions during that. So we'll see a bunch of you at the 4:30 Ask Me Anything happy hour. And other than that, Joel, Wendy, and everybody else, thank you so much for joining us.
You're welcome. Thank you. Bye-bye.
Bye.